Guy saves $1 million, quits his job. 18 months later, he's begging for his old cubicle back. Another guy retires with $3 million in dividend stocks, spends 40 hours a month managing his portfolio and dealing with tenant calls. Third guy calculates he needs $2.4 million to retire, gets there. Decides actually he needs $4 million because now he wants the boat. What's the pattern? They all believe the same lie, that passive income means you stop working and money appears. The real math looks nothing like the YouTube ads. And the psychology? Even worse. Here's what we're actually doing today. I'm going to show you the 3 versions of passive income that exist in reality, not fantasy. We'll break down why the famous 4% rule is quietly failing people right now in 2026. I'll explain the 25x trap that keeps you working 5 extra years for expenses you don't even enjoy. And most importantly, why people with 8-figure portfolios still feel broke. This isn't about motivation. It's about the actual mechanical systems that either give you freedom or create a new prison with better furniture. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Think of your money as a goose. Not the golden goose from the fairy tale, just a regular goose. You can do 3 things with this goose. You can eat it, that's spending your principal. You can collect the eggs it lays, that's cash flow. Or you can let it grow, raise more geese, and occasionally eat one of the younger geese while the flock keeps expanding. That's the total return model. Most people obsess over which strategy is best. Here's what actually matters. The goose doesn't care about your strategy. The goose cares about whether you panic and cook it during a bad winter. Let's start with the model everyone knows, the 4% rule. Back in the 90s, a guy named William Bengen ran the numbers on historical stock and bond returns. He found that if you have a portfolio, withdraw 4% of it in year 1, then adjust that dollar amount for inflation every year after, you have about a 95% chance of not going broke for 30 years. Simple math from that, take your annual spending, multiply by 25, that's your freedom number. Need 40,000 a year, you need 1 million invested. Need 80,000, 2 million. On a spreadsheet, this looks bulletproof. Here's the first problem. Bengen used data from 1926 to 1992. You know what that data set includes? The greatest bull market in human history. Post-World War II American economic dominance. Interest rates that actually paid you to hold bonds. The 4% rule isn't a law of physics. It's a probability based on a very specific historical moment. Morningstar, the investment research firm, has been quietly revising this down. In some of their recent analyses, they've suggested 3.3% might be safer for someone retiring today. You think that's a minor tweak? Let's run it. If you need 40,000 a year and the safe rate is 3.5%, not 4, you don't need 1 million. You need 1.14 million. That's an extra $140,000 you have to save. That could be 3 more years of your life working, all because the math changed by half a percentage point. And here's the thing that makes this worse. The 4% rule isn't even passive income in the traditional sense. You're selling pieces of your portfolio every year. You're liquidating your geese. You're just betting that the remaining geese reproduce faster than you can eat them. Now you're asking yourself, what about inflation? Exactly. Let's say you retire today with $1 million. You pull out 40,000 in year 1. Feels great. But if inflation runs at 3% annually, which is below the long-term average, in 20 years, you need $72,000 just to buy the same groceries and pay the same utility bills. If your income is fixed, a bond ladder, or an annuity that pays a set amount, you're getting a pay cut every single year without realizing it. This is why people who retire on fixed corporate pensions from the 80s are now struggling. The number looked huge in 1985. It buys cat food in 2026. The total return model, the one where you own index funds and sell small pieces annually, has one massive advantage. Stocks generally outpace inflation. They're a hedge. If you own a slice of global business and business raises prices, your portfolio grows. But this comes with a price: volatility. You have to be comfortable watching your $1 million portfolio drop to $700,000 and still sell $40,000 worth of shares to pay rent. Most people are not wired for this. Most people panic. They sell everything at the bottom, lock in the loss, and destroy their entire plan. The math works. Human psychology doesn't. Here's the escalation most people miss. Flexibility is worth more than a bigger pile of money. If you can dial your spending down to 3% of your portfolio during bad years and 4% during good years, your odds of success don't go up by 10%. They roughly double. A guy retires with exactly $1 million and a fixed $40,000 budget. The market drops 25% in year one. He's forced to sell $53,000 worth of shares just to pull out his $40,000 in cash because the shares lost value. He's now sitting on $747,000. Another bad year, and he's mathematically cooked. Same guy, same million, but he has a freelance gig that can generate $20,000 if needed. Market tanks. He pulls 20 from the portfolio, earns 20 from the gig. His burn rate just got cut in half. 5 years later, when the market recovers, he's not just alive, he's thriving. The second guy didn't have more money. He had optionality. But you might be thinking, Tom, I don't want to sell stocks when they're down. I want dividends. I want rent checks. I want cash flow that just appears, so I never touch the goose. That's the dream everyone sells. Mailbox money. The reality is way uglier and way more expensive than anyone admits. This is where the math goes from tricky to punishing. The cash flow model is seductive. You own 10 rental units, collect $4,000 a month in rent. You own $200,000 in dividend aristocrat stocks, yielding 4%. That's $8,000 a year. You wrote a book, earn $300 a month in royalties. In this model, you never sell the asset. You live off what it produces. The goose stays whole. You just take the eggs, and if the market crashes, you theoretically still get your rent check. It feels safer. It feels tangible. That feeling of safety is exactly why people rush in without doing the actual accounting. Here's the trap. Revenue is not income. I cannot stress this enough. Some guy buys a duplex, rents it for $2,000 a month. He tells everyone he has $24,000 in passive income. No, that's gross revenue. You have to subtract property tax, insurance, vacancy rates, repairs, property management if you don't want to be a landlord, and capital expenditures, roof replacement, HVAC, foundation work. After all that, your actual net cash flow might be $700 a month, not $2,000. And that's before income tax. To replace a $40,000 salary with actual net rental income, free and clear properties, you might need 8 to 12 units, depending on your market. Congratulations. You're not a passive investor. You're a property manager with a very expensive hobby. Let me tell you about a guy I know who did this. Bought 6 rental units over 10 years, got to the point where the net income covered his basics, quit his engineering job. 6 months later, he's spending 15 hours a week dealing with contractors, tenant disputes, city permits. One tenant stopped paying rent. Eviction process took 4 months. No cash flow from that unit, but all the expenses kept coming. He told me, and this is a direct quote, I traded a boss I hated for 6 tenants who text me at 11 p.m. because the garbage disposal is making a noise. He went back to engineering part-time within a year, not because he ran out of money, because he ran out of patience. Real estate can scale, but it's rarely truly passive unless you pay a management company, which eats another 8 to 12% of your gross rent. The math still works for some people, but the psychology is different than you think. You are buying yourself a job. The IRS might call it passive income. Your calendar will call it Tuesday. Same applies to dividend stocks. You think you're clipping coupons. What you're actually doing is researching which high-yield stocks aren't value traps, rebalancing when yields drop, watching for dividend cuts. If you spend 10 hours a month on this, you're working. It might be better than your corporate job. It isn't passive. The solution isn't to avoid cash flow. It's to treat it as a stabilizer, not the engine. Most people who actually make this work use a hybrid core portfolio in index funds for growth and total return. Layer of cash flow, maybe rental income or dividends, to cover the absolute essentials. Rent, utilities, groceries. If the stock market crashes, you know you can still eat and keep the lights on without selling shares at a loss. The cash flow doesn't have to cover everything. It just has to let you sleep at night when your stock portfolio is down 30%. Here's the part that breaks people's brains. Your spending is 10 times more important than your investment returns. I'm going to prove it with math you can't argue with. Every dollar you spend annually requires $25 of invested capital to support it forever. That Netflix subscription isn't $15 a month, it's $180 a year. Which means you need $4,500 invested, working for you, just to pay for Netflix. Forever. A $500 car payment? That's $6,000 a year. You need $150,000 in your portfolio just to sustain that one line item. When you view expenses through this lens, luxury doesn't cost the price tag. It costs years of your life accumulating the backing capital. I'm not saying don't enjoy anything. I'm saying be honest about the trade. That $60,000 truck doesn't cost $60,000. It costs the 3 years you'll work to save $1.5 million to support a $60,000 lifestyle. Most people never do this math. Then they wonder why their freedom number keeps moving. There's a concept called the passive FI ratio. Your passive income divided by your expenses. If you spend $40,000 a year and have $10,000 coming in from dividends or side projects, your ratio is 25%. You're a quarter of the way there. But here's what's interesting. You don't need to hit 100% to feel the benefits. At 30% coverage, let's say your passive income covers rent, your risk tolerance changes completely. You can take a pay cut for a better job. You can tell your boss no without sweating the mortgage. At 50% coverage, you could work part-time doing something you actually enjoy. You're not working to survive, you're working to thrive. The psychological trap is lifestyle creep. Moving goalposts. I've watched this happen in real time. Guy hits 500,000 net worth. That was his original target. Suddenly he needs $1 million. Hits $1 million. Now he needs 2 because he wants a boat and business class flights. If your spending rises in lockstep with your income, you never get free. You're just running on a faster treadmill wearing nicer shoes. The people who actually pull this off freeze their lifestyle. They decide what enough looks like and defend that number against marketing, peer pressure, and their own ego. There's this couple, early 50s, who retired with $1.2 million. Not a huge number. They live in a paid-off house in a medium cost of living area. They figured out their annual spend is $34,000. They grow vegetables. They cook. They don't vacation in Europe. They road trip. Their withdrawal rate is under 3%. They've been retired for 6 years, never run out of money, never felt deprived. I asked them what their secret was. The wife said, "We decided we liked each other more than we liked impressing neighbors." Their life didn't look like an Instagram ad. It looked like freedom. Here's the protocol. Focus on the gap between what you earn and what you spend. Your savings rate is the single biggest determinant of when you can retire. Save 10% of your income, you're looking at 4 decades of work. Save 50%, you compress that to 12 to 15 years. It sounds extreme until you realize it's just math. Every dollar you don't spend is a double win. One more dollar invested and one less dollar your portfolio has to generate forever. Attack spending first. It's the only variable you can control completely today. Now we get to the monster in the room. The thing that can destroy a perfect plan even if you did everything right. It's called sequence of returns risk. And if you ignore it, you could save for 30 years, hit your number, quit your job, and still go broke in 5 years. All because of what the market does the day after you give notice. Sequence of returns risk says that the order of your investment returns matters as much as the average. Let's say you expect 7% average annual returns over 30 years. If the market crashes 20% in the first 2 years of your retirement while you're withdrawing money to live, you dig a hole so deep the portfolio never recovers. Even if the market booms later, you're selling shares at the bottom to buy groceries. This permanently destroys your capital base. But if you retire into a bull market, you're basically invincible. It's luck. And it's terrifying because you can't predict it. Run the numbers on a bad sequence. You retire with exactly $1 million. Year 1, market drops 20%. You're at $800,000, but you still need your $40,000 to live. Now you have $760,000. Year 2, market drops another 10%. You're at $684,000. You take another $40,000, adjusted for 3% inflation, so $41,000. You're at $643,000. In 24 months, you burn through more than a third of your money. To get back to even, the market would need to go on a historic run. but you have less capital to catch that ride. The math is broken. This is why average return calculators are dangerous. They assume smooth sailing. The market is a roller coaster built during an earthquake. The psychological component of sequence risk is panic. When you watch your life savings drop 25% the year after you quit your job, every instinct screams, sell everything and go to cash. But selling at the bottom locks in the loss. It's the financial death blow. It's easy to be a long-term investor when you have a paycheck. It's agony when your portfolio is your oxygen. Here's the protocol, the cash buffer. Keep 1 to 3 years of living expenses in cash or short-term bonds when you retire. Market crashes in year 1, you don't sell a single share. You spend the cash. Live off savings while your stocks recover. Historically, market recoveries take 2 to 4 years. Once the rebound happens, you replenish the buffer. This acts like a shock absorber. Yes, holding that much cash drags down long-term returns slightly, but it buys you insurance against selling stocks at a 25% loss to buy a sandwich. It's the difference between surviving and thriving. We've covered the money and the math. Here's the part nobody talks about until they faceplant into it. The reason people achieve financial independence and then go back to work within 18 months, it has nothing to do with inflation or returns. It's what happens to your brain when the alarm clock stops mattering. There's a difference between retiring from something and retiring to something. If you're just running from a job you hate, you'll crash once the relief wears off. 1 week at the beach is vacation. 1 year at the beach is an existential crisis. Humans derive massive amounts of identity, status, and purpose from work. Strip that away suddenly, and you're left staring at a void. I've seen people with $2 million spiral into depression because they underestimated their need for structure. The myth is that humans are built for endless leisure. We're not. We're problem-solving machines. Without problems, we invent them. You'll obsess over the lawn. Argue with strangers on Reddit. Reorganize the garage 4 times just to feel engaged. The most successful people in the passive income world don't stop working. They stop doing work they hate. They shift to optional work. Passion, business, volunteer work, consulting on their terms. The goal isn't to do nothing. It's to have complete control over what you do. This is the concept of lean FI versus fat FI. Lean FI is where passive income covers bare bones survival. You can eat, you have shelter, but you're counting pennies and 1 car repair is a crisis. This is stressful and fragile. Fat FI is where passive income covers a luxury lifestyle with margin, obviously safer. Takes twice as long to reach. The sweet spot is what I call coast fi. You reach a baseline where survival is guaranteed by passive income, but you keep doing some enjoyable work to fund luxuries and keep your brain engaged. The job becomes optional. That changes everything. You don't need it to eat, so it becomes fun again. Let me tell you about a guy who got this right. Worked in software, saved aggressively, hit 1.4 million at age 42. His bare minimum annual spend was $35,000. His FI ratio at a 3% withdrawal rate was 120%. He was free. But instead of retiring to a beach, he started a small software consultancy, works maybe 20 hours a week, picks his clients, charges premium rates because he can say no, clears another $60,000 a year doing work he actually enjoys. His portfolio keeps growing. He's not retired. He's liberated. There's a difference. The final protocol is this. Design the life before you design the portfolio. Don't race to a number hoping happiness is waiting there. Test drive retirement. Take a sabbatical if you can. Build hobbies that don't involve consumption. Develop income streams aligned with your interests, not just ROI. If you can build a life you don't want to escape from, you might find you don't need as much money as you thought. You just need enough to buy autonomy. So can you live off passive income? Yes. But stop looking for one magic strategy. It's an ecosystem. You build a foundation of low-cost index funds for growth, layer in some semi-passive cash flow for stability. Keep a cash buffer for bad years, keep your skills sharp and your options open. The most secure people aren't the ones with the biggest pile. They're the ones who are flexible. They can scale spending down or scale income up, depending on what the world throws at them. I've been investing for over a decade. I've made every mistake in this video at least once. I've panicked and sold at the bottom. I've chased yield into garbage dividend stocks. I've underestimated how much cash flow actually costs to generate. What I learned is that the math is easy. The psychology is brutal. Your biggest enemy isn't the market. It's the voice in your head that says you need more safety, more luxury, more status. That voice will keep you working until you're 70 if you let it. Here are your 3 takeaways. 1. Your freedom number isn't 25 times your current spending. It's 25 times your minimum spending. Learn the difference. 2. Build flexibility into your plan. A side gig you enjoy, a skill you can monetize, a cash buffer. Flexibility beats a bigger portfolio. 3. Test the life before you quit the job. If you can't fill a 3-day weekend without spending money or feeling bored, you're not ready to retire. You're ready for a therapist. Lazy investing built more fortune than crypto memes. The people getting rich off passive income aren't the ones optimizing for another 0.5% of yield. They're the ones who figured out what enough looks like and stopped moving the target. If you want to see exactly how I structure my own portfolio to balance these risks, there's a video on my channel breaking down my actual allocation. Numbers included, no affiliate links, just math. Thanks for watching.